Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And welcome. We're going to be talking about money, of course. It is the program about money. Welcome. We're happy you're here. We're happy you're listening. Federal Reserve held a meeting. It said that they were going to pause on rates, but you can probably expect two more before the end of 2023. Maybe. They didn't make that for sure, but maybe. They are seeing a little bit of progress in curtailing inflation, but little is the key word.
The supply chain was down. The PPI numbers down. Yeah. The supply chain's loose.
So we're gonna come back and talk about that later in the program. So don't go away. You want to hear about that? You know, one of the things that investors and money managers and financial advisors depend upon is stock analyst. You know, do you know how it really works? Do you think it's really objective and your best interest and the best interest of investors? Think again. We're going to tell you today how it really works and why you shouldn't really trust analysts. We do our own research at AFC. We have for a number of years. We don't rely on the analyst. We kind of read the analyst at times. We kind of chuckle at what they have to say at times. Sometimes we take it seriously. But what is how it really works? We're going to talk about that. But we're going to begin with something completely different. We're going to begin talking about shadow banking. And for that, Al?
Mike, you're not supposed to use it. They do not like and call it shadow.
Ah, that's true.
You're hurting their feeling.
Ah.
You know, there was a politician in Boston, the old infamous gangster was Whitey Bulge.
Uh-huh.
Well, his brother was just as evil on the other side. He was a politician. His name was Billy Bulge. And in the 80s, Howie Carr of the Boston Globe gave him a nickname. He was a vertically challenged guy like myself. And Howie Carr gave him a nickname. He called him the corrupt midget. Not a politically correct term now, but that's what he called him. And it really irritated Billy Bulge. He did not like that nickname. And his response was, do they have to call me a midget? Shadow bank. Mike, if it looks like a duck, acts like a duck, and quacks like a duck, it's probably a duck.
It is.
Not necessarily.
But
we have these institutions out here that act like bank. They loan money. They loan it on the long term. They borrow on the short. The only difference, they don't take deposits. They don't have the regulations and scrutiny that our banks, and in the current environment we're seeing mid-level and regional banks going under, and I think we'll see more before it all settles out. We have these institutions that they said they don't like the name shadow bank. Pension funds, the hedge fund, mortgage companies, Fannie Mae and Freddie Mac are considered shadow bank
because they're loaning money, but they don't fall under the banking regulations.
No. And
they have in what we call the shadow banking, what you and I call the shadow bank, they have as much money on loan as the regular banking system.
They somewhere in around of $200 and some odd trillion, which is half of the world economy, basically shadow bank.
And little or no regulation.
Exactly. Now the question is what's the big deal, right? If they go under, the banks will be fine. Well, that's not necessarily the case, because though they don't take in deposits and they lend money, they're borrowing money from the larger bank. And so in a sense, are they just fronts for larger banks to do things that the banks can't do because of regulation? And then it comes back to the larger banking system. Is the larger banking system at risk because of the shadow banking?
And even if they're not leveraging from borrowing money from the banks, they can have a significant impact. $44 trillion is put into hedge funds or to pension funds. Mm-hmm. And you have money market funds, which contain $9 trillion. And the idea was that money market funds would never break the $1. They were always going to be worth $1. But the dollar was broken once before. It can be broken again.
So in 2007, I guess to give you perspective, the global shadow banking peaked at 60, declined to $59 trillion during crisis, and rebounded to $92 trillion by the end of 2000. That's what we're talking. We're talking about real money.
Real money.
And so how does this affect investors? What's the risk to our client investors?
If you look at it, we're probably not in the same situation as we were in 2007, 2008.
No.
At that time, you had a lot of the shadow banking system that had CMOs, CDOs, credit default swaps, repos, things that almost no one had ever heard of.
No, but the repos are still going on.
The repos are still going on. Yeah. So are the collateralized debt obligations.
Can you tell everybody what a repo is so people got to really understand what a repo?
A repo is probably a collateralized mortgage obligation or a debt obligation. So you group together all these mortgages. You know, what we saw in 2007, 2008, they grouped together the mortgages from subprime, and regular mortgages as well. And they put them together into a package and consider it a bond. And that then is something that trades every 7 days. On a Tuesday or a Thursday, I don't remember which day, they go to the market, and so they're auctioned off. And so the interest they pay changes every 7 days. In the old days, you know, here I talk about the old days, like
you like talking
the
about you like talking about the old days.
1970s, 1980s, as these were beginning to first be structured, they were called 7-day sevens, because every 7 days they would roll over. And in those days, the 1970s, the standard interest rate was almost 7%. So they were called 7-day sevens until they weren't 7-day sevens anymore. They were 7-day sixes, and then they were 7-day fives.
But let me just break this down. But the basic function is you have an investment that the federal government pays you for that investment, and then you buy it back at a later date.
Yes, it can be.
At a set higher price.
It can be. But it can also be the collateralized mortgage obligation, and that's more frequent, is a mortgage obligation rolled up with interest rates coming in from the homeowners, and you package enough of them together and you assume that there's going to be very few defaults. And what they do is, back in 2007, 2008, is you had the shadow banking. The shadow banks were actually, and today, do deposit their funds in a bank. So, for example, Silicon Valley Bank, the one that went under, had depositors of hundreds of billions of dollars. Since the federal government didn't guarantee those, the depositors wanted some sort of guarantee. And so to guarantee those bonds, that money is invested in part or in full into credit default swap, or not credit default swaps, but repos. And they're called repos is because they can be repossessed at any time. And they're traded. And that becomes the equivalent of what a small investor, you and me, if we put our money in the bank, we have FDIC. If you have 45 million or 100 million in the bank, you have the repos that are equal to the 100 million. And sometimes it's not repos, sometimes it is government bonds. More safe considered on government bonds than the repos, because we went through the 2007, 2008. But still, those are the guarantees. And what happened in 2007, 2008 is when the subprime mortgages began to come apart, the repos began to trade down. And so the depositors were asking for more money to be deposited, or more assurance, more insurance of their deposits. And, you know, you got into a vicious cycle. One domino fell, then another, then another, then another. But that goes on today. Pension funds with cash, they want more than just the U.S. government bonds guaranteeing that. So you have the repo, collateralized mortgage obligations, or borrowing from the government in U.S. treasuries.
But the fact that this is not transparent, we don't see it, and there's no regular bank, is the real issue. And according to this article from the IMF, International Monetary Fund, they're just as much in the dark as we are about the shadow banks. They can't figure out how much leverage they have. And that's the problem.
That's the issue. Silicon Valley Bank, you knew was going under because you could look at their assets and their liabilities, and you knew that they were upside down. With what's going on in some pension funds, insurers, broker-dealers, money market funds, hedge funds, you don't know for sure.
And according to the 1933 security, banks do not have to disclose their registered securities, right? They're inside a trade. It's some little wrinkle in it. They don't have to disclose it. And you've mentioned before that you stay away from investing in banks. And I was reading something on one last point. There's reading something with Howard Marks, who runs a $140 billion distressed debt with Oak Tree Capital. He says the same thing. He says, I don't like investing in banks. I can't figure them out.
It's tough. I quit investing in banks a long time ago when Washington Mutual wrote their junk bond debt down to zero. I thought it's a one-time hit. And then they can just take it as income after that. Don't go away. We've got more to cover. Real issues in shadow banking. Don't go away.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So to finish up on shadow banking, Mike, are we anywhere close to where we were in 2007? I mean, there's risk out there, always will be, but are we at those levels?
Probably not. I mean, the banking system is in good shape.
Yeah.
Maybe there's one or two a few small banks that are going to be good, but not many. So the real question is the private shadow banking that we don't know anything about.
Yeah, and we're hearing a lot about the risks to the real estate market, commercial, and we've mentioned it before, but I think a lot of those are going to be renegotiated. I don't think those are going to go belly up, and people are going to walk away from the note, and the banks are going to cancel the notes. They're going to say, hey, let's sit down and talk.
And there's going to be a few where people already have walked, but it's going to be few and far between.
Yeah, but this goes right along with our next topic.
Before we go there.
Oh, you back up.
I want to remind people of how bad the Great Recession really was, because it's all in the past. It's done. We don't think that the shadow banking is going to be anywhere close to that. But the Great Recession was 5 times worse than the Great Depression. It may not have seemed in many ways it was because of the reaction that Bernanke and Geithner had in facing it. But the bond spreads were twice as wide in 2007 and 2008 as they were in 1929. And by the way, our clients really benefited from that because we got some really incredible buys, as much as a 20 or 30% gain within 6 months.
Yeah, unlike 2008, in 29, 28, and 27, they reduced the money, which exacerbated.
The Great Recession, there was $15 trillion of household wealth that disappeared. 9 million people lost their jobs. I mean, that's the potential risk of something of the shadow banking system going down. Mm-hmm. So don't go away. The probability is low, but it's not zero.
And it never will be zero.
Never will be zero.
There'll always be some sort of systematic risk. You can't diversify or anything else.
No, what you can do is make sure you have more money than you really think you're going to need, so that if you do get into a crunch, when the thing goes down, you've got excess capital that you can use.
And you don't have to liquid investment. It'll come back.
Yep. So anyway, let's move on to one of Wall Street's dirty little what I call Wall Street's dirty little secrets. Because advisors and money managers really depend upon endless research. You see them come out and a stock misses their earnings by 1 penny and the stock drops 15%. But I have a story to really illustrate what really goes on because I was involved. Early in 1986, I got started in biotech. Very early on. Very few companies, but I got to know the analyst. My daughter, who would go on from high school to college to major in microbiology and marketing, and would go on to become an investor relations person in the biotech industry. We got really well known in the industry. She was still in college in the 1990s, and by 1990s, the biotech was coming into its own. And there was a company called ProCyte. ProCyte had developed a copper-based iamine gel for treating ulcers, plantar ulcers on the heel of the foot. To go through clinical trials, you first of all, you try the gel or any drug on an animal to see that it works. Then you take it into a phase 1 clinical trial where you see if it's safe for humans, it doesn't cause any significant side effects. And if that works, then you take it into a phase 2 where you give different doses and determine what the correct dose is. And then into a phase 3 trial, which is a blinded trial where neither the doctor or the patient knows if they're getting the drug, or in this case, the gel, or if they're getting a placebo. And you compare the results of those. And in this case, coming out of phase 2 clinical trials, ProCyte determined that 2% was the right amount of gel to use. So they came out of phase 2. They said that the average closure on plantar ulcers was 67% versus 13% for the placebos. That's very significant. 67% closure of the ulcer versus 13. They also mentioned that they had 32% fewer infections with the people that got ProCyte versus 6% for the people that got the placebo. So they went into phase 3 and they called it a phase 3 double-blind test. Doctors didn't know. Patients didn't know. That was the assumption of the test. So there was a biotech conference, and during one of the breakout sessions, my daughter was in some of the sessions, I was in some of the sessions, and it was actually my daughter who asked the question. She said, doesn't that give the iamine gel a blue color? Well, yes, it does. Well, the placebo, how do you get a blue color in the placebo? Well, we don't. So you mean that the treatment group, the one that are getting the ProCyte product are getting a blue gel and the people that are getting the placebo are getting a clear gel. Well, yes. So doesn't that mean that the doctors and the patients know whether they're being treated or not? Anyway, they danced around that. And with that information, I shorted the stock at $10, around $10 a share for a number of clients. So skip forward, and they're now waiting for the phase 3 clinical results to come out. And because I had gotten to know a lot of the biotech analysts, and I was invited to a conference call where the analysts, 5 of the 6 analysts covering the stock, were on this conference call. It was on a Friday. And the 5 analysts thought that the results were going to be out very, very shortly, and it was a table-pounding buy. The conclusion from that talk, and I had nothing to say during the talk because I'm short the stock, not long the stock. Those analysts were all saying it's a table-pounding buy. Go out to all your financial advisors, stockbrokers at the time, go out and tell them to buy the stock. So I spent Saturday. I spent 8 or 10 hours on Saturday going through the data, plowing and thinking, working through the whole thing. And I was beginning to think the stock I bought at 10, shorted at 10, was now 12. I was underwater. My clients were underwater. The question is, do I close and take the loss? I was the only one that was really negative. Everyone else, all these analysts whose specialty was biotech, and that's all they did. And they followed 3 or 4 or 5 companies. That's all they did. And one of those analysts was at Dane Rauscher, where I was, and I worked for Dane. And the results actually were announced prior to the opening on Monday. And they announced that the phase 3 clinical trial had failed. The stock opened at $2 on the day. So it had closed at over 12 on Friday. It opened at 2. Now, the point is not that I was correct on the stock, not about that, but I want to talk about the analyst, because analysts get paid in 2 ways. They get a salary and they get a bonus. And the bonus is based on several different things. It's based on how their stocks perform. So if they say buy and the stock goes up, they get a reward for that. That's part of their bonus. If they say sell and the stock goes down, that's positive performance for them, and they get bonus for that. If they say hold and the stock still goes up, they get some, but not as much as if they would have had a buy. But it's a lot easier to be a hold if you have questions about what the stock's going to do rather than do a buy. But performance counts. Secondly, they get paid on the investment banking that goes on. So when they're covering these biotech stocks, or if they're covering airlines, or if they're covering different companies, they come across companies that are either going to go public or going to be merged. And so if they find one of those companies and refer it to the investment banking within their firm, they get a nice bonus. I know as an advisor, if I found one of those companies and referred it to investment banking, I would get a big chunk of money, 2 to 3 to 4% of whatever that came public at. So it's not a minor amount. And the analyst gets that amount as well. And the third thing they got the bonus on is the commissions that are generated in their stock. So when they come out, and in this case, the analyst came out prior to the opening of the market. And how the bonus works in those cases is the analyst wrote her sell on ProCyte stock prior to the opening of the market. So because it was before the opening of the market, the analyst got credit for that stock being at 12 when she wrote a recommendation, even though there was no way in those days to have sold the stock at 12. You could only sold the stock once it opened at 2. But she got credit for saying the stock is a sell, and part of her bonus was based on the performance that the stock went from 12 to 2. That's a significant change. That's a year's worth of bonus, or 2 years worth of bonus. But that wasn't all that she got. Let me tell you the rest of the story. So we're coming to a commercial break. Don't go away. I'll tell you the rest of what happens, and then we'll talk about whether analysts are really objective and whether analysts really have your best interest in mind or their bonus in mind. So don't go away. It's what I call one of Wall Street's dirty little secrets, not in your favor, in their favor.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So I've been talking about what goes on. Analysts, one of Wall Street's dirty little secrets. Their interest is their interest, not your interest. And I gave the story of ProCyte. ProCyte was a stock in the 1990s that had a gel. The gel was supposed to work, but I had a good chance of being right when I saw that the gel in phase 3 clinical trials was not a double-blind test, but everybody knew whether they were getting the gel or getting the placebo. And so when they announced the results, the stock on Friday had been trading at 12. They announced the results on Monday. The stock opened at 2. The analyst got credit for selling at 12 because that's where the stock closed on Friday, and it opened at 2. So she got credit for a $10 gain. That was huge. Analysts get paid, as I mentioned, on 3 things. 1, on the performance of their stock, 1 on the commissions generated in the stock, and 3rd on the investment banking. Well, think of this case. She got a huge performance bonus because the stock went from 12 to 2, but she knew it was going to do that. On Friday, she had it as a table pounding buy. On Monday, before the market opened, a sell. 100%. There was no hindsight. She could see exactly what was happening. Secondly, when she came out with a sell, a huge number of people were selling the stock, and as well they should have, and creating commissions for the firm. And so she got a big commission for that. And then from Institutional Investor, the magazine, she got a big award for having such great performance. And she went on to quit Dane and get a big bonus to move to another firm.
Well, Micah, every firm has their own vernacular.
Yeah.
Here's a firm, A.G. Edwards. I read a funny article in Barron, so it's, why can't you just say buy or sell? You see, A.G. Edwards, buy, hold, sell, advanced equity, strong buy, accumulate, neutral, advest, strong buy, market perform, market underperform. BBT Capital, strong buy, long-term buy, hold, underweight, BMO, top pick, buy, outperform, market perform, underperform.
Oh, yeah.
And the article concluded in Barron's like, wait a second, you either have a buy or a sell. End of story.
But that means the analyst has to really come out and say, I really believe in this.
Right.
I believe in my numbers. And we've talked before, analyst projections on earnings are always wrong, almost always wrong. They're wrong over 95% of the time.
Yeah.
I mean, and some of that is with a grain of salt when we say that. When they come out and they say the earnings are going to be $2.32 a share, it's $2.31, they were wrong. But they were generally in the ballpark. Now, if they say $2.32 is what they're going to earn, and it earns $1.10, that's really being wrong on your outlook. Mm-hmm. People look at being 232 versus 231 or 231 versus 232 as being wrong. I don't really consider that.
Well, you and I had a stock in the portfolio that an analyst came out and said, oh, it's a sell. Stock dropped, 15, 18% in one day?
Yeah.
And that analyst went and looked him up, and his rate of return is 6.1%.
Yeah.
And so what's his motivation? The stock is starting to rebound after he said. One guy comes out and says, oh, this is a sell, and the stock tanks 15.
Don't forget, that same analyst had a buy on that stock
and
with a high target price. And when they announced that they were going to do a secondary offering through another firm,
yeah,
within a day or two, that analyst came out with a sell.
He came out with the sell on the stock in March, and the stock doubled.
Yeah,
they sell, and the stock doubled since his rating.
But he lost some on performance, but he made a ton of money on commissions. In total, I'll bet if you looked at the bonus, that analyst made a significant amount of money, and because the stock was a long way away from the secondary offering, the sell made a lot of commissions, whereas had they just continued to hold it as a buy, wouldn't have made the commissions.
It's like I was telling a friend of mine before I was coming to show about an old book. It's called, Where Are All the Customers' Yachts? You know the story?
Yep.
You know the story, right? But for our audience who doesn't, the broker's taking his potential client down to the waterfront, and I think it's in Newport, Rhode Island, and gets down to the waterfront and says, well, these are all the broker's yachts. And the customer says, well, where are all the customers' yachts? It's not a thick read. It's about 100 and something pages. It's a whimsical, cartoonish read. It's really funny. These analysis of Wall Street, and what a bunch of hucksters some of them.
They are. But that's how analysts get paid. And that same analyst, because the stock had tripled or quadrupled from the time they came out with the sell, it had gone up. Now comes out with a reiteration of the sell, gets a bunch of more commissions, gets some performance bonus because the stock went down, and it is June after all, and we are coming to bonus time, the quarterly bonus.
Yeah, and I got the book, the test you take to become a research analyst.
Yeah.
And when I read the book, I studied the book because I just want to see, well, what the heck do they really have to know? It isn't that much. You'd be surprised. You'd think it's going to be dig deep in this. It's more about compliance and about just appeasing the SEC. And I don't think FINRA really gets involved. They might. I don't think so. But it's just more or less a compliance of what you can say, what you can say. That's what the test is on. It has nothing to do with actually analyzing the stock.
You know, I went through the .com time, and one of the great ads, which was just detested by the brokerage industry, was one, I think it was done by Schwab, about the manager who's talking to all the stockbrokers, the financial advisors, about this stock. We just came out with an announcement. Let's put some lipstick on this pig and get it out to our clients. I loved that ad because it was so very true.
Oh, yeah, and there's a funny, are you a Sopranos fan, Mike? There's an episode of The Sopranos where one of the guys to get his stockbrokers, and they set up a stockbroker, and he's the compliance officer. So they're supposed to push this company called Webistics, and this one analyst is on the phone, and he's saying, "No, Webistics, that's a terrible stock. You ought to be into this stock and that stock." And the two guys go over there and beat him up. But that's the industry in a nutshell. You've seen the Wolf of Wall Street.
The Wolf of Wall Street. I mean, that is, and it takes on this form of sophistication. And you look at the firms and the independent ratings. We do our custodian with Interactive Brokers, and they show you who's rating each stock and how they rate it and the performance of the analyst. And they show you a rating of each analyst from 1 to 5 and all those things. And the question is, how much is really in the client's best interest and how much is in...
We've talked about before, Mike, is the market makers. How much inventory are these companies sitting on in the stock that they need to push?
Yeah.
Right? If I'm holding 20 million, 50 million shares of XYZ company and I got to push that out the door, that's the largest part of my inventory. Which stock am I going to push?
Yeah. No, the market makers, you know, when they get hit with a load of stock or have to short a lot, they really work that stock to get rid of it, because market makers like to be flat at the end of the day. Not long, not short, just flat. That's traditional where they are. But to be a market maker, you have to be willing to be the buyer and the seller. And so if there are more sellers than buyers, then you end up owning the stock. And if there's more buyers than sellers, you end up short the stock. So market makers are just functional.
Yeah, because you think of not just the banks and stuff that do this, but the big brokerage firms like, an Edward Jones or an LPL, because they can they're a broker dealer. So they're not just brokering the stock to the clients, but the dealer side, they can buy and hold and have an inventory of stock and deal with that and have to say, okay, to their 11, 15,000 agents, hey, we have a huge inventory of the stock.
And that's, I don't think many investors understand the difference between a broker-dealer and just a custodian.
Nope, there's no clue. They think it's just, guy, my broker-dealer, he just sells me, he helps me buy and sell stock, but that's not really what...
No, when it says broker-dealer, a broker is someone that gets paid a commission to move the money from a seller to a buyer-seller. He gets one side of the transaction. A real estate broker is the person that will sell the house or buy the house. You're never involved in the actual principle that's involved. As a dealer, you get to buy and hold inventory and sell inventory. And for bonds, that's really critical because bonds trade less than stocks, and there's not an apparent market for bonds. And so most of the dealers in bonds are actual dealers. They're not just brokering. So, when clients are dealing with a Merrill or a UBS or a Morgan Stanley, you're dealing with a broker-dealer. And from there, you get into what are the dark pools.
Now we're going from shadow banking to dark pools. Now we're going to a black hole.
We've just drifted off the subject.
I think it all goes along because people can't figure out. There's a great book out there called Flash Boys.
Yes.
About the black pools and the dark pools, and people, even hedge funds, couldn't figure out who was front running their trades and things like that. It's crazy, the high frequency trading. When you get into the dark pools and those things, you have no clue what's going on.
And that's one of the main reasons I left Fidelity, because of their dark pool.
And you're skimping an eighth of a penny. Doesn't sound like a lot, but when you're trading 1 billion shares, it's real money.
We're coming back. We're going to talk about darkness. We're going to go off script. We're going to talk about dark pool because I like dark. I like talking about Wall Street's dirty little secrets.
Go read Flash Boys if you get a chance. It'll blow your mind.
About money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So when I left Wachovia, for 18 and a half years, I was in the wirehouses. First with Payne Weber, which is now UBS, then with Dane Bosworth, which is now RBC, and then eventually a company that became Wachovia, which now is Wells Fargo. During that period of time, you just work with the company that you're with, a wirehouse. But once I formed Adams Financial Concepts in 2005, I went with Mid-Atlantic Capital, which is a broker-dealer. And in 2010, I broke off from Mid-Atlantic Capital just to go with a custodian. And that custodian was Fidelity. No longer broker-dealer. It was just a place to house stocks. But what I didn't realize at the time is that Fidelity had its own dark pool. All the big firms had a dark. And there was a reason to do that way back when companies on NASDAQ were large, the Microsofts, those companies were very large. And when they wanted to trade 1 million shares or 12 million shares, it's hard to do if you're doing it through an exchange like the New York Stock Exchange. So there was some reason to do that. But it became a dark pool where nobody knew what was there. The companies knew what was there. And they would trade for their own benefit within that dark pool. And I noticed something that was really strange that was happening because I do my own trades. I would put in an order to buy 100 shares of a stock at 30 and a quarter. And 100 shares would execute. And then the price would move from 30 and a quarter up to 30 and a half, or 30 and 3/8, or from $30.25 to $30.35, or something like that. And I finally would execute the trade at the higher price because it didn't make a huge amount of difference. But I noticed on a sell, the same kind of thing would happen. 100 or 200 shares would go at the price I wanted to sell, and then the rest would never trade. And sometimes, if I was really determined to set that price and let it run, I would do that all day long. And most of the times, I could not get out of the stock I was trying to sell. I couldn't buy what I wanted to buy. I had to go with whatever the market price. And the market price seemed to almost always reset when I put in an order. What I found out, and I didn't realize until I read a book that you mentioned now, Flash Boys, is the dark pools sit there and the traders can see what they have. They can see what you have. The traders at Fidelity can see that I want to buy 100 shares at $30.25. And so they will actually execute, usually on one of the exchanges like BATS, and there are now 12 or 14 exchanges. It's not like the York and the American.
But they wouldn't just take your 100 shares, Mike. They'd pool it with a bunch of other and buy a huge block at the same time, right? And so Bill Ackman, who of Pershing Capital, complained about that with the doc because he said he couldn't figure out why he wasn't getting the prices in the book because he was being front run. They'd see, oh, Bill Ackman's got $20 billion. He's buying $1 billion of Microsoft. Oh, he's buying it at 130 and 2 3/8. We're going to buy it right before him at 130 and 1/8. And that's a lot of money.
Well, they can't buy in front of him, but they can execute a couple shares and then buy.
Well, that's what he said, because they were front running him. They were getting a price better. He wasn't getting the price that he wanted.
Yep.
So he was complaining about that. And if you haven't read the book, what's happened with the dark pools and high frequency trading is these guys, they kept trying to move their exchanges closer and closer to Washington so they get their trades as fast as they could to the exchange.
And they set up Spread, which was a fiber optics network that ran straight through because you could save 4 milliseconds. And they were selling that, renting that for $20 million per person, and had an unlimited number of people that were willing to pay $20 million to use that.
Yep.
But that was the dark pools. And Merrill commissioned somebody to look at it and say that it was in the best interest of the client. They came back and said, no, it's in the best interest of Merrill, not the client.
Yeah.
All these little secrets that go on, and they trim a little bit off everybody, and they make billions of dollars because of doing that.
But it costs the average retail investor who takes it short. It costs them money.
Yep.
Trading fees cost money. It's not free to trade stocks. You say it's free. They tell you it's free, but it's not free.
It's not free. So in 2015, having set up in 2010 to do Fidelity, in 2015, after reading Flash Boys, I wanted to do just the IEX exchange. And Fidelity said, you can't choose the exchange. So I chose a different custodian and moved everybody to Interactive Brokers. For now, when I trade, I can actually decide who I want to trade with. I can decide to trade IEX. I can decide to trade Island. Or I can decide to trade any of the other exchanges. I can actually pick the exchange. And because it is so transparent, I don't even have to do that. I mean, I can see the exchanges. I can see that I get best execution. I can see that no one is front running me.
Mm-hmm. It's important to get it's just a fundamental integrity to get the right price. When you buy it 58 and 3/4, you want 58 and 3/4.
And, in the long term, I use the example of a stock that I bought in 96. Bought it at $10 to $12 a share. And it's been the longest stock in our portfolios. It split 2 for 1, then 3 for 1, then 4 for 1. And the cost basis on the shares is now 87 cents to $1.02. The stock trades over $100. So whether you bought the stock at 87 or 100 or $1.02, it doesn't really make a lot of difference. Whether you 10 or 12 doesn't make a lot of difference. That's a 20% difference. But today, does it really make much of a difference? No. But it's the principle of the thing really bothers me.
Well,
it bothers me that I could have put the order in at 10 and had to execute at $10.10 because somebody was front running that.
Well, there was another, just to make it a point of this, Mike, there's a story in I read about Dollar General, a company that sells, dollar store, and people were going up to the register with their stuff. This would be the best example to compare this, is people were going up to the register with their stuff, and they said, the laundry detergent was $5.99. They get up there and it'd be $6.34 or $7.50, and they couldn't figure why the price did. There was a big investigation in the company because their prices were not, when they got up to the register, were completely different and much more than what they were paying. And that's the same thing that you're talking about. It's just the integrity of, wait, if it's $5.99 when I get up there, it should be $5.99, not $6.34.
Yep. Anyway, we drifted off onto dark pools. We started talking about Wall Street's dirty little secrets. There's a whole lot of them, but we'll spend some more time talking about it in future programs, because now that we've launched into it, why not talk about what's going on, especially in these times when it's so difficult. With inflation so persistent, with the market doing what it is, it's important to understand what's going on and why it's happened. We're coming to a commercial break. Don't go away. If you missed any of this program, you can find it on YouTube. You can log in, click on About Money, and you can find this program and some of the programs in the past. You can also find these programs on our website. So take time and go back and look at some of the things we've done. Take a look at what our results have been, because every contract we sign says that we want to outperform the Standard & Poor's 500 total return over the 5 to 10 year time period. And we've done that. We're not looking at 1 year, 2 year, 3 year time. It's nice when it happens, but we're looking at the long term. That's where we're really at in terms of what we want to do for our clients, and it's working. And we're going to talk about why that's so important. Have a very good week, and we'll be back next week. We will talk about more dirty little secrets.